Some people genuinely turn down a raise or ask their employer to hold off on it because they believe it'll push them into a higher tax bracket and they'll actually end up with less money overall. That's not how it works, not even close. And the actual mechanism is simpler and more reassuring than most people realize. By the end of this video, you'll know exactly how marginal tax brackets work, see the real math with concrete numbers, and never have to wonder again whether a raise could possibly cost you money. Quick note before we start, this video uses simplified, rounded numbers to clearly illustrate the mechanism. Actual bracket thresholds change periodically, so always check current figures for your specific situation. Part 1. The myth everyone believes. The myth goes like this. Tax brackets work like a light switch. Cross a certain income threshold and suddenly your entire income gets taxed at the new, higher rate, meaning a small raise could theoretically push your total tax bill up by more than the raise was even worth. This belief is common enough that it has a name in tax literacy circles, the bracket myth. It's persistent because the word bracket itself sounds like a single rate that applies to your whole income, and because most people have never actually seen the calculation done out loud, line by line. It's also an understandable thing to worry about. Losing money from a raise would be a genuinely strange and unfair outcome. The good news is that it's not how the system is actually built. Part 2. How marginal tax brackets actually work. The U.S. federal income tax system, and most income tax systems globally, uses what's called a marginal bracket structure. Here's the key idea. Each bracket only taxes the portion of your income that falls within that specific range, not your entire income. Picture it like a series of buckets stacked on top of each other, each with a different tax rate, and your income gets poured in from the bottom up. The first bucket gets filled first, taxed at the lowest rate. Once it's full, income starts filling the next bucket up, taxed at a slightly higher rate, but only the income inside that second bucket, not what's already sitting in the first one. For illustration, let's use simplified, rounded brackets. 10% on income from $0 to $10,000, 12% on income from $10,000 to $40,000, 22% on income from $40,000 to $85,000. If you earn $50,000, you are not taxed at 22% on the full $50,000. You're taxed at 10% on the first $10,000, 12% on the next $30,000, the portion from $10,000 to $40,000, and 22% only on the final $10,000, the portion from $40,000 to $50,000. Crossing into the 22% bracket only ever affects the dollars that are actually inside that bracket. Part 3. A real worked example, step by step. Let's follow one person through an actual raise using those same simplified brackets to see the myth fall apart with real numbers. Sam earns $50,000. Using the brackets above, 10% on the first $10,000 equals $1,000, 12% on the next $30,000 equals $3,600, 22% on the remaining $10,000 equals $2,200. Total tax, $6,800. Take home, $43,200. Sam gets a $5,000 raise, now earning $55,000. Still within the same 22% bracket as before, so this part is simple. The extra $5,000 is taxed at 22% equals $1,100. New total tax, $7,900. New take home, $47,100. Take home pay went up by $3,900 on a $5,000 raise. Nobody loses money here. They keep 78 cents of every additional dollar in this bracket, which is exactly what a 22% marginal rate means. Now let's push Sam's raise further into the next bracket. Say a bigger raise to $90,000, crossing into a hypothetical next bracket of 24% above $85,000. Brackets up to $85,000 are taxed exactly as before. Only the $5,000 above $85,000 is taxed at the new 24% rate equals $1,200. Every single dollar below $85,000 is still taxed at the same rates it always was. Even crossing a bracket threshold entirely, only the new dollars above that line are taxed at the new rate. There is no scenario under this system where earning more results in less take-home pay overall. Part 4. Marginal rate versus effective rate. This distinction is exactly why two different numbers exist, and conflating them is most of where the myth comes from. Your marginal rate is the rate applied to your last dollar earned, the bracket your top dollar falls into. In Sam's $55,000 example, the marginal rate is 22%. Your effective rate is your total tax divided by your total income, the real blended percentage you actually paid overall. For Sam, at $55,000, $7,900 in tax divided by $55,000 in income comes out to roughly 14.4%. Notice the gap. A 22% marginal rate, but only a 14.4% effective rate. That gap exists precisely because the lower brackets are still being taxed at their lower rates underneath. People who fixate on their marginal rate, assuming it describes their whole tax burden, are the ones most likely to believe the bracket myth, because 22% sounds like a lot more than the 14.4% they're actually paying overall. Part 5. Why this myth is so persistent. A few reasons this misunderstanding keeps spreading. The word bracket genuinely sounds like a single flat rate, and most explanations stop at naming the percentage without ever walking through the layered calculation. Pay stub withholding can add to the confusion. Employers sometimes withhold a higher percentage on bonus checks or large one-time payments specifically because of how short-term withholding tables work, which can make a bonus feel like it was taxed punitively, even though it gets reconciled correctly against the actual marginal brackets when you file. And a few specific situations do involve real cliffs. Certain tax credits and government benefit programs phase out based on income thresholds, sometimes abruptly, which is a real phenomenon that can, in narrow cases, make an additional dollar of income cost you more in lost benefits than the dollar itself is worth. That's a genuinely different mechanism from the income tax bracket system, but it gets blended into the same myth in casual conversation. Part 6. Mistakes. This misunderstanding leads to Mistake 1. Declining a raise or promotion out of bracket fear. As shown in Part 3, this is never mathematically justified by the bracket system itself. A raise always increases take-home pay, dollar for dollar, within the new bracket. Mistake 2. Panicking over a bonus that seems taxed too high. This is usually a withholding table issue, not a final tax bill issue. Most over-withheld bonus tax gets refunded or reconciled when you actually file, since your real tax is calculated on your full year marginal brackets, not the withholding rate applied in the moment. Mistake 3. Ignoring legitimate phase-out cliffs while fixating on the wrong mechanism. If you're near an income threshold for a specific credit or benefit, that's worth understanding directly and specifically. But it has nothing to do with how your base income tax brackets work, and conflating the two leads to the wrong conclusion about ordinary raises. Mistake 4. Not accounting for deductions before worrying about brackets at all. The standard deduction, or itemized deductions, reduces your taxable income before any bracket is even applied, meaning your bracket calculation starts well below your actual gross salary, often by a meaningful amount. A raise can never mathematically leave you with less take-home pay under a marginal bracket system. Every additional dollar you earn is taxed at most, the rate of the bracket it falls into, and every dollar below that point keeps being taxed exactly as it always was. So here's the one action. If you've ever hesitated about a raise, a bonus, or extra income because of bracket fear, walk through the actual math from Part 3 with your real numbers. You'll very likely find the gap between your marginal and effective rate is larger and more reassuring than you expected. If this finally cleared up a myth that's probably cost someone you know real money, subscribe. Next video breaks down exactly how deductions and credits work, step by step, to actually lower what you owe.